hidden spreads, and how to negotiate them. Imagine for a moment that you've just decided to buy silver. You've done your research, you understand the fundamentals, you've watched the market, and you're ready to act. You go online, find a dealer, click purchase, and congratulations, you're now a silver owner. But here's what almost nobody tells you. The moment you click that button, you may have just paid anywhere from 5 to 20% more than you needed to. Not because the dealer is necessarily dishonest, but because of something most investors never see, never question, and certainly never negotiate. Hidden spreads, the invisible tax that drains wealth from millions of silver buyers every single day. Now, if that grabbed your attention, if you're realizing there might be layers to this game you haven't considered, then do yourself a favor right now. Subscribe to this channel, because what we're about to uncover isn't just about saving a few dollars on your next purchase. It's about understanding the architecture of precious metals markets, how pricing actually works, where the money really flows, and most importantly, how you can position yourself on the winning side of these transactions instead of being the one quietly losing value with every trade. Let's start with a fundamental truth that will change how you see every silver purchase for the rest of your life. When you buy silver, you are not just buying a commodity. You are entering a transaction with multiple layers of pricing, each layer extracting value, and most of those layers are completely invisible to you. The advertised price, the one you see on the website, in the catalog, or on the screen, is merely the starting point. It's the surface. Beneath it lies a complex structure of premiums, fees, spreads, and margins that determine what you actually pay and what the seller actually makes. Here's how it works. Silver has a spot price. That's the baseline, the global market price for an ounce of pure silver at any given moment. It fluctuates constantly, driven by supply, demand, currency movements, and broader economic forces. But you can't buy silver at spot. Nobody can really, except perhaps large institutional players dealing in futures contracts or massive bulk transactions. For everyone else, for you, for me, for retail investors, there's a markup. That markup is called the premium, and it's where the game begins. The premium is supposedly there to cover costs, manufacturing, distribution, dealer overhead, storage, insurance, and of course, profit. Fair enough, right? Businesses need to make money. But here's where it gets interesting. The premium isn't fixed. It's not transparent. It's not standardized across the industry. Two dealers can sell you the exact same coin, same weight, same purity, same mint, and charge you completely different premiums. One might add $3 over spot, another might add $8, and most buyers, they never compare. They never question. They just assume the price they're seeing is the price. But the premium is only part of the spread. The spread is the difference between what a dealer will sell silver to you for and what they'll buy it back from you for. Think about that for a second. You buy a silver coin today, you pay spot plus premium. Let's say spot is $25 and the premium is $4. You pay $29. Now, imagine you need to sell that coin back tomorrow. The dealer isn't going to give you $29. They're not even going to give you $25, the spot price. They're going to offer you something lower, maybe 23, maybe 22. That gap, that difference between your purchase price and their buyback price is the spread. And it's where fortunes are quietly transferred from buyers to sellers every single day. Now, most people don't think about this because they're focused on the long term. They're not planning to sell tomorrow. They're stacking for years, maybe decades, and that's a sound strategy. But here's the problem. Even if you hold for years, that spread still matters because it defines your true entry cost. If you overpay on the way in, you're starting from a deficit. Your silver has to appreciate more just to break even. And in a market where movements are often measured in single-digit percentages over months or years, starting with a built-in loss of 10 or 15% is devastating. Let me give you a concrete example. Suppose you buy 10 ounces of silver. The spot price is $25, so the metal itself is worth $250. But the dealer charges you a premium of $5 per ounce. Your total cost is $300. Now, 6 months later, spot has risen to $28. Your metal is now worth $280 at spot. Sounds like a gain, right? But if you go to sell, the dealer offers you buyback at $2 under spot. That's $26 per ounce, $260 total. You paid $300, you're getting back $260. Spot went up and you still lost money. That's the power of the spread. It's a silent killer of returns. But here's where it gets even more insidious. The spread isn't just about dealer margins. It's also a function of liquidity, market conditions, and product type. Some forms of silver carry wider spreads than others. Generic rounds, for instance, often have lower premiums when you buy, but also lower buyback values. Government-minted coins like American Eagles or Canadian Maples carry higher premiums, but tend to have better liquidity and tighter spreads on resale. Rare or collectible coins, numismatics, can have enormous spreads because their value isn't just tied to metal content, but also to rarity, condition, and demand among collectors. Buying the wrong product for your goals can lock you into spreads that are impossible to escape. Now, most investors don't know this. They walk into the market blind, trusting that the dealer is giving them a fair price. And maybe the dealer believes they are. But fairness in this context is relative. The dealer's job is to make money. Your job is to preserve and grow wealth. Those two objectives are not always aligned. Understanding that misalignment is the first step toward protecting yourself. So let's talk about the routes of purchase, because this is where the spread starts to vary wildly and where your choices can either save you or cost you dearly. There are essentially four main routes through which retail investors buy silver: online dealers, local coin shops, auctions, and secondary markets, and direct from mints or bulk suppliers. Each route has its own pricing structure, its own spread dynamics, and its own hidden costs. Online dealers are by far the most popular route today. They're convenient, they offer a wide selection, they publish prices clearly, and they ship directly to your door. But convenience comes at a cost. Online dealers typically have higher premiums than you might expect because they're factoring in the full cost of doing business digitally: payment processing fees, shipping, insurance, customer service, web infrastructure, marketing. All of that gets baked into the price you pay. And because the transaction is remote, you have less room to negotiate. The price is the price. Take it or leave it. Moreover, online dealers often advertise their lowest premium products prominently to attract traffic, but those ultra-low premium items are frequently out of stock or available only in limited quantities. Once you're on the site, you're nudged toward higher premium products. It's a classic bait and switch, not in a deceptive sense necessarily, but in a strategic sales sense. The advertised deal gets you in the door, but what you actually end up buying costs more. And because you're comparing across multiple tabs, multiple sites, it's easy to lose track of the true all-in cost. Then there's payment method. If you pay by credit card, many dealers add a surcharge, sometimes 3 or 4%. That's another hidden cost. If you pay by bank wire or check, you might avoid that fee, but you're also adding time and sometimes your own bank's fees. Cryptocurrency payments are becoming more common and can sometimes reduce fees, but they introduce exchange rate risk and volatility. Every payment method has a cost, and those costs add to the spread, even if they're not labeled as such. Local coin shops, on the other hand, offer a different dynamic. You can walk in, see the product, handle it, and most importantly, negotiate. This is huge. A local dealer has flexibility. They can adjust premiums based on volume, repeat business, or simply the relationship they build with you. If you're buying regularly, they have an incentive to keep you as a customer. That can translate into better pricing. But local shops also have limitations. Their inventory is smaller. Their overhead, rent, utilities, staff is often higher than online operations, which can push premiums up. And their buyback prices can be unpredictable because they're managing cash flow and inventory turnover in real time. Auctions and secondary markets are where things get really interesting. Buying silver from other individuals through estate sales, online marketplaces, or auction sites can sometimes yield incredible deals. You might find someone who needs cash quickly, doesn't know the true value, or is simply motivated to sell. In those cases, you can buy below typical retail premiums, sometimes even near spot. But this route requires knowledge, time, and a willingness to take on risk. You need to verify authenticity, assess condition, and navigate payment and shipping without the protections a dealer offers. It's not for everyone, but for those who master it, it's a powerful way to reduce the spread. Finally, buying direct from mints or bulk suppliers is the holy grail for minimizing premiums, but it's usually only accessible at scale. If you're buying hundreds or thousands of ounces, you can sometimes arrange terms that bring your cost much closer to spot. But for most retail investors, this isn't realistic. The minimums are too high, the logistics too complex. Still, understanding that this option exists helps you see where the pricing structure begins and how much markup is truly being added at each layer of the distribution chain. Now, here's the thing. Each of these routes has a spread, but the width of that spread varies dramatically. And most investors never compare. They pick one route, usually online because it's easy, and they assume they're getting a fair deal. But fair compared to what? Without a baseline, without understanding what's possible, you can't know if you're being taken advantage of or not. And that ignorance, that passive acceptance of whatever price is offered, is exactly what allows spreads to remain wide and profits to flow silently away from buyers. So how do you negotiate these spreads? How do you take control of the transaction instead of being controlled by it? The first step is awareness. You now understand that premiums and spreads exist, that they vary, and that they are not fixed laws of nature. They are business decisions, and business decisions can be influenced. The second step is comparison. Never, and I mean never, buy silver from a single source without checking at least 2 or 3 others. Compare premiums, compare buyback policies, compare total all-in costs, including shipping and fees. This alone will save you significant money. The third step is negotiation. Yes, you can negotiate when buying silver. Not always, not everywhere, but more often than you think. Local dealers especially are open to this. If you're buying in volume, if you're paying cash, if you're a repeat customer, ask for a better price. The worst they can say is no, but often they'll shave $1 or $2 off the premium, and over dozens or hundreds of ounces, that adds up quickly. Even some online dealers will negotiate on large orders if you call them directly instead of just clicking buy. Most people never try, so they never know. The fourth step is timing. Premiums fluctuate based on supply and demand. When silver prices spike and demand surges, premiums widen because dealers can charge more and inventory tighten. When prices are stable or falling and demand is soft, premiums compress because dealers need to move product. Buying during periods of low demand, when premiums are tight, is a simple but powerful way to reduce your cost basis. It requires patience and discipline, but it works. The fifth step is product selection. As I mentioned, different products carry different spreads. If your goal is purely wealth preservation and you don't care about collectability or brand, then buying the lowest premium product that still has good liquidity makes sense. Generic rounds or bars from reputable mints often fit this profile. If you want better resale liquidity and are willing to pay a slightly higher premium upfront, government coins are usually the better choice. Understanding your goals allows you to match the product to the strategy and avoid overpaying for features you don't need. The sixth step is understanding buyback policies before you buy. This is critical and almost universally ignored. Before you purchase, ask the dealer what they'll pay if you sell back. Not in 6 months, right now. What's their current buyback price for the exact product you're buying? That tells you the true spread. If they're selling at 5 over spot but buying back at 3 under spot, that's an $8 spread on a $25 spot price. That's 32%. Think about that. You'd need silver to rise 32% just to break even. That's absurd. If a dealer has a spread that wide, walk away. Find someone with a tighter spread, even if it means paying a slightly higher premium up front. Now let's talk about something most investors never consider, the role of volume. If you're buying 1 ounce at a time, you're almost certainly paying the highest premiums and getting the worst spreads. Dealers make their money on small transactions because small buyers don't have leverage. But if you're buying 10 ounces, 50 ounces, 100 ounces, suddenly you have leverage. You're a more valuable customer. Your transaction is more profitable in absolute terms, even if the margin per ounce is lower. Use that leverage. When you're ready to make a larger purchase, don't just click buy. Call the dealer. Ask for a volume discount. You'll be surprised how often they'll offer one. And here's a strategy almost no one uses: building relationships. If you're serious about stacking silver over the long term, find 1 or 2 dealers you trust and do repeat business with them. Let them know you're a regular buyer. Over time, they'll start offering you better terms because they value the relationship and the predictable revenue. This is how the smart money operates. They don't chase the lowest advertised price every time. They build relationships that give them consistent access to fair pricing and favorable terms. But let's go deeper. Let's talk about the hidden psychological traps that keep investors locked into bad spreads. One of the biggest is the illusion of urgency. Dealers and marketers are experts at creating a sense of scarcity and urgency. Limited supply, prices rising. Order now. This triggers fear of missing out. And when you're in that emotional state, you stop comparing, you stop negotiating, you just buy. And that's exactly when you pay the highest premiums and accept the widest spreads. The antidote is discipline. Have a plan. Know your target price. Don't deviate from it just because someone tells you the opportunity won't last. There's always another opportunity. Another trap is brand loyalty or emotional attachment to certain products. Some investors only want American Eagles or only Canadian Maples or only a specific commemorative series. That's fine if you understand you're paying a premium for that preference. But if your goal is wealth accumulation, brand loyalty is a luxury you may not be able to afford. The silver content is what matters. 1 ounce of $9.99 fine silver is 1 ounce of $9.99 fine silver, regardless of the stamp on it. Don't let marketing or aesthetics drive you into paying premiums that undermine your financial goals. Then there's the trap of small, frequent purchases. Buying a little bit at a time feels manageable and less risky, but it's also the most expensive way to stack. Every transaction has a cost: shipping, payment processing, the dealer's time. When you spread those costs across a small number of ounces, your effective premium skyrockets. If you're serious about accumulating silver, save up and make larger, less frequent purchases. The per ounce cost will be significantly lower. Now, I want to address something that often gets overlooked: the ethics and transparency of the dealer. Not all dealers are created equal. Some operate with high integrity, offering clear pricing, fair spreads, and honest communication. Others are less scrupulous. They advertise low premiums on products they never have in stock. They press you into higher margin items. They obscure fees and conditions. They offer terrible buyback prices and hope you never come back to sell. Doing your due diligence on the dealer, reading reviews, checking their reputation in the community is just as important as comparing prices. A slightly higher premium from a trustworthy dealer is often a better deal than a slightly lower premium from someone who's going to create headaches later. And here's something that rarely gets discussed: the tax implications of how and where you buy. In some jurisdictions, sales tax applies to precious metals purchases, adding another layer of cost. In others, there are exemptions if you buy above a certain dollar amount. Understanding the tax laws in your area can influence your purchase strategy. Buying just above the exemption threshold to avoid sales tax, for instance, can save you several percentage points, effectively tightening the spread. Let's also talk about storage and insurance, because these are hidden costs that affect your true cost of ownership. If you buy silver and store it at home, you might think you're avoiding costs, but you're taking on risk. If it's lost, stolen, or damaged, you bear the full loss. If you insure it, that's an ongoing cost. If you use a third-party storage facility or a dealer's storage program, there are fees, sometimes significant ones. These costs don't show up in the spread at purchase, but they compound over time and eat into your returns. Factor them in when you're calculating the real cost of your silver holdings. Now, I want to shift gears slightly and talk about the broader market structure, because understanding this gives you power. The precious metals market is not as efficient or transparent as stock markets. It's fragmented with thousands of dealers, varying standards, and limited price discovery for retail transactions. This fragmentation is what allows spreads to remain wide. If the market were more transparent, if every dealer's buy and sell prices were published in real time on a central platform, spreads would compress dramatically because competition would force them down. But that transparency doesn't exist, at least not yet. So the burden is on you, the buyer, to create your own transparency by doing the research and comparison that the market structure doesn't provide. There's also the reality that dealer margins are not uniform. Some dealers operate on thin margins and high volume. Others operate on high margins and lower volume. Knowing which type of dealer you're working with helps you understand their incentives. A high volume, low margin dealer is more likely to negotiate because they need to keep inventory moving. A high margin, low volume dealer may be less flexible but might offer other value like expertise or rare products. Matching your needs to the right type of dealer is part of the strategy. And then there's the question of why spreads exist at all beyond just dealer profit. Part of it is genuine cost. Refining, minting, distributing physical silver is not free. There are real expenses. But part of it is also market power. Dealers have information and infrastructure that you don't. They know the wholesale market. They have relationships with mints and refiners. They understand inventory management. That asymmetry of information and capability creates an imbalance, and imbalances create profit opportunities. Your job is to reduce that asymmetry as much as possible. Learn the market, understand the products, build knowledge. The more you know, the less you pay. Let me give you a real world scenario to illustrate all of this. Imagine two investors both decide to buy 100 ounces of silver. Investor A goes online, finds the first dealer with a decent reputation, sees a premium of $6 over spot, pays by credit card, incurs a 3% fee, and completes the purchase. Total cost, spot at $25, premium $6. That's $31 per ounce, plus 3%, another $93. Total, $31.93. For 100 ounces, that's $3,193. Investor B takes a different approach, compares 5 dealers, finds one offering a $4 premium on a similar product, calls them, negotiates down to $3.50 because of the volume, pays by bank wire, no credit card fee, ships to a local pickup location to save on shipping insurance. Total cost, spot 25, premium 350, 28.50 per ounce. For 100 ounces, that's $2,850. Investor B just saved $343 on the same amount of silver. That's a 12% difference. Over a lifetime of stacking, that difference compounds into tens of thousands of dollars. But here's the deeper point. It's not just about saving money on this one transaction. It's about mindset. Investor A is passive, accepts what's offered. Investor B is active, questions, compares, negotiates. That mindset difference doesn't just apply to buying silver. It applies to every financial decision. It's the difference between being shaped by markets and shaping your position within them. Now, what about selling? Because the spread works both ways, and understanding the sell side is just as important as understanding the buy side. When you go to sell silver, you're now on the other side of the transaction. The dealer is buying from you, and they're going to offer you less than spot. Why? Because they need to make a margin when they resell it. They also need to account for the risk that spot price might drop between when they buy from you and when they sell to the next customer. And they need to cover their costs of verifying, storing, and marketing the product. All of that comes out of what they offer you. But here's the key. The buyback price is negotiable too. Most sellers don't realize this. They walk in, ask what the dealer will pay, hear a number, and accept it. But if you're selling volume, if you've built a relationship, if you've done your research and know what other dealers are offering, you can negotiate a better buyback price. Again, the worst they can say is no. Often they'll come up, especially if they're looking to acquire inventory, and timing matters on the sell side just as much as on the buy side. If spot prices are rising and dealers are seeing strong demand, they're more aggressive in their buyback offers because they know they can flip the product quickly. If demand is soft, they're more cautious and offer less. Selling into strength, when premiums are elevated and demand is high, can significantly improve your net proceeds. There's also the option of selling peer-to-peer, bypassing dealers entirely, online marketplaces, local classifieds, even precious metals forums allow you to sell directly to other investors. This can eliminate the dealer spread entirely, letting you capture more of the value. But it requires time, effort, and trust. You need to verify the buyer, arrange secure payment, handle shipping or meetups, and accept the risks that come with private transactions. For some, it's worth it. For others, the convenience and security of selling to a dealer justifies the lower price. Now, let's address a controversial topic. Are spreads ever justified? Is there a moral dimension to this? From one perspective, spreads are simply the cost of doing business. Dealers provide a service, liquidity, convenience, expertise, and they deserve to be compensated. From another perspective, excessively wide spreads, especially when they're not transparent, feel exploitative. They take advantage of buyer ignorance and extract value that doesn't correspond to the value delivered. The truth, as usual, is somewhere in between. Reasonable spreads that reflect genuine costs and reasonable profit are justified. Excessive spreads that exist solely because the market allows them are harder to defend. But here's the thing. Morality aside, the market is what it is. Your job as an investor is not to judge it, but to navigate it effectively. Understanding spreads, knowing where they come from, and learning how to minimize them is part of financial literacy. It's part of taking control of your wealth instead of being a passive participant. And that brings me to the bigger picture. The reason we're talking about spreads and purchase routes in such detail is not just about silver. It's about a mindset. It's about refusing to accept information, asymmetry. It's about questioning systems that seem fixed but are actually negotiable. It's about recognizing that in every market, in every transaction, there are winners and losers. And your position is determined not by luck, but by knowledge, discipline, and action. This applies to buying silver, yes, but it also applies to every financial decision you make. Real estate, stocks, bonds, businesses, all of them have hidden costs, spreads, and information asymmetries. Learning to see them, to question them, and to navigate them is what separates those who build wealth from those who merely hope to. So let me leave you with this. The next time you go to buy silver, don't just click the buy button. Pause. Ask yourself, do I understand the full cost of this transaction? Have I compared multiple sources? Have I tried to negotiate? Do I know what the buyback price would be? Am I buying the right product for my goals? Am I letting emotion or urgency drive me? Or am I acting from a place of discipline and knowledge? These questions might seem small, but over time, over dozens of transactions, over years of stacking, they make the difference between wealth preservation and wealth erosion. Remember, this content is educational and not financial advice. Its purpose is to help you think more clearly about your decisions. The markets don't care about your intentions. They reward preparation, knowledge, and discipline. Hidden spreads are real. They're draining value from millions of investors every day, but they don't have to drain value from you. Now you know they exist. Now you know how they work. Now you know how to negotiate them. The question is, will you act on that knowledge, or will you go back to being passive? The choice, as always, is yours. But the market won't wait, and neither should you.